For 6 years, I contributed to my 401k without ever opening the investment options menu. I selected the default fund during onboarding. I increased my contribution percentage twice. I checked the balance occasionally. I assumed that because I was participating, I was doing it correctly. What I did not know was that my default fund carried an annual expense ratio of 1.12%, and that, inside the same 401k plan, available on the same menu I had never opened, was a total market index fund with an expense ratio of 0.03%. Same account, same employer match, same tax advantages. One fund costs 37 times more than the other every single year. My name is David. Today I am going to show you exactly how much that difference costs in real retirement dollars, which specific fund type almost always wins the comparison, why your employer's default selection is almost never the optimal one, and the exact steps to find and switch to the better option inside your current 401k tonight. Let me start with the expense ratio because most people have heard the term and almost nobody has calculated what it actually means to their specific account. An expense ratio is the annual percentage of your investment that the fund charges to operate. It is deducted automatically from fund returns. You never see it as a line item on your statement. It simply reduces the growth your money experiences every year. At 0.03%, a $100,000 investment costs $30 per year in fees. At 1.12%, the same $100,000 investment costs $1,120 per year in fees. That is the difference between the two funds available inside the same 401k that I ignored for 6 years. $30 versus $1,120 annually on the same balance for the same account type with the same tax treatment. Now, let me show you what that difference compounds to over a 30-year investing timeline. Assume two investors. Both start at 30 with $50,000. Both contribute $500 per month. Both earn an average gross return of 7% annually before fees. Investor A is in the 1.12% expense ratio fund. Net return after fees, approximately 5.88% annually. Investor B is in the 0.03% expense ratio fund. Net return after fees, approximately 6.97% annually. At 60 after 30 years, Investor A has approximately $592,000. Investor B has approximately $698,000. The difference, approximately $106,000. From the same contributions, same starting balance, same gross market return, different fund inside the same account. $106,000 is not the cost of a bad investment decision. It is the cost of never opening the investment options menu. Now I want to explain why the default fund in most 401k plans is almost never the optimal one, because understanding this prevents the problem from continuing. When a company sets up a 401k plan, they work with a plan administrator, a financial services company that manages the plan infrastructure, processes contributions, and provides the investment menu. These administrators are compensated in part through the expense ratios of the funds they include on the menu. Funds with higher expense ratios generate more revenue for plan administrators. The default selection, the fund employees are automatically enrolled in when they never open the options menu, is frequently one of the more expensive offerings. This is not always deliberate predation. It is a structural conflict of interest built into how most 401k plans are constructed and how plan administrators are compensated. Research from the Center for Retirement Research at Boston College found that the median expense ratio across all 401k plan options is approximately 0.48%. The median expense ratio of the default fund, specifically, the one most participants end up in, is approximately 0.72%. The default costs roughly 50% more than the median available alternative. And the optimal alternative, a broad market index fund, is typically available in most plans at a fraction of both numbers. Now let me introduce 3 people whose situations illustrate exactly how this plays out across different income levels and career stages. The first is Jordan. He is 26 and has been in his first professional job for 2 years. His 401k balance is approximately $14,000. He is contributing 6% of his salary to capture the full employer match. Jordan is in the default fund. He has never opened the investment options menu. He does not know what an expense ratio is. He knows only that he is contributing and that the match is being received. His default fund expense ratio is 0.84%. The total market index fund available in his plan has an expense ratio of 0.04%. At his current balance and contribution rate, the 30-year cost of staying in the default fund versus switching to the index fund, approximately $62,000. Jordan is 26. The switch takes approximately 15 minutes. The cost of not switching, $62,000. The second is Renee. She is 38 and has been with her current employer for 7 years. Her 401k balance is approximately $89,000. She has reviewed her statement quarterly for 7 years and is satisfied with her returns. What Renee does not know is that her satisfaction is based on the nominal return percentage shown on her statement, which does not reflect what her returns would have been in a lower-cost alternative. Her fund returned 6.2% last year. The market returned 7.1%. The difference is not market performance, it is expense ratio drag. Her fund expense ratio is 0.91%. The index fund in her plan, 0.03%. 30-year projection from her current balance and contributions. The cost of not switching is approximately $148,000. Renee has been a careful investor. She checks her statements. She increased her contribution rate 3 times. She did everything she understood to do. She just never opened the investment options menu. The third is Marcus. He is 44 and has multiple 401k accounts. His current employer's plan and 2 unconsolidated accounts from previous employers that he has not touched in years. His current employer plan, expense ratio 0.67%. His first old account, invested in a target date fund with expense ratio 0.82%. His second old account, in a money market fund, returning approximately 4.1% with an expense ratio of 0.2%. Marcus has 3 separate accounts, each suboptimally invested, generating 3 sets of fees that he has never seen as a combined number. Combined annual fee drag across all 3 accounts on a total balance of approximately $230,000, approximately $1,890 per year. Not as a statement line, just as growth that never occurs. Rolling the 2 old accounts into his current employer's index fund option or into a rollover IRA with a zero-cost index fund eliminates the fee drag on those balances while simplifying management to 1 account and 1 login. The 15-year improvement from consolidation and switching to the index fund, approximately $84,000 in additional account value at retirement. Now I want to explain specifically what the total market index fund is and why it consistently outperforms the majority of actively managed alternatives over long time horizons. A total market index fund holds every publicly traded company in the United States stock market, weighted by market capitalization. It does not require a team of analysts to select stocks. It does not require management decisions about which sectors to overweight. It simply holds the market. Because there are no analysts to pay, no research teams to fund, and no trading activity beyond the minimum required to track the index, the operating cost is near zero. Hence the 0.03% expense ratio at providers like Fidelity and Vanguard. The S&P 500 Index Fund is the most common alternative. It holds the 500 largest U.S. companies rather than the entire market. The total market version adds smaller companies and provides slightly broader diversification, but both are dramatically superior to most actively managed alternatives on a cost-adjusted basis. The evidence on this is not ambiguous. Spiva, The S&P indices versus active research, published twice annually, consistently shows that over 15-year periods, approximately 90% of actively managed large-cap U.S. equity funds underperform their benchmark index net of fees. 90% of actively managed funds that charge higher fees to beat the market fail to beat the market over 15 years. The one or two funds that do outperform are not identifiable in advance, and the search for them requires paying the higher fees that almost always eliminate the outperformance they might generate. The index fund is not a sophisticated strategy. It is the strategy that the evidence consistently supports over every time horizon that matters for retirement planning. There is one more concept worth understanding before you make the switch, and it is the one that makes the index fund decision feel even more obvious once you see it clearly. It is called tracking error. An actively managed fund employs a team of analysts and portfolio managers who make ongoing decisions about which stocks to hold, when to buy, and when to sell. This activity generates trading costs, the cost of executing transactions inside the fund, which are separate from the expense ratio and further reduce net returns. Index funds, by contrast, trade minimally. They only buy or sell when the composition of the index itself changes, which is infrequent. The trading cost of a total market index fund is negligible. The combined effect of the expense ratio and trading costs in actively managed funds is typically 1.5% to 2% annually. The combined cost of a total market index fund is typically below 0.1%. Over 20 years, the difference between earning 7% gross and earning 5.2% net, which is approximately what the cost drag of a typical actively managed fund produces, versus 6.9% net from the index fund, is not a minor efficiency gain. It is the difference between retiring with the account you planned for and retiring with significantly less. A woman named Elena, 41, made this comparison for the first time using her actual 401k statement. Her actively managed fund had returned an average of 5.4% net over 10 years. The S&P 500 index, the benchmark the fund was compared against, returned an average of 7.1% over the same 10 years. Her fund underperformed its benchmark by 1.7% annually for a decade. Her balance at the 10-year mark was approximately $16,000 lower than it would have been in a simple index fund. Elena had been paying a higher fee for a fund that delivered lower performance than the free market would have provided. She switched the same afternoon she ran the comparison. The switch took 18 minutes. Now I want to give you the exact steps to find the index fund in your current 401k and make the switch tonight. Step 1. Log into your 401k account. If you do not have the login credentials, find the plan administrator name on your most recent statement and create an account online. This takes approximately 10 minutes. Step 2. Find the investment options menu. It is typically labeled Fund Options, Investment Choices, or similar. You are looking for the complete list of available funds, not just the ones you are currently invested in. Step 3. Look for any fund with the words Total Market, S&P 500, or Index in the name. If you find one, click on it and look at the expense ratio. If it is below 0.1%, this is almost certainly your optimal choice. Step 4. Compare it to your current fund. Find your current fund's expense ratio. The difference between the two numbers, multiplied by your current balance, tells you approximately how much you are paying in excess fees annually. Step 5. Change your investment election. There are 2 changes required. Future contributions, the setting that determines where new money goes, and current balance, the setting that moves existing money from the current fund to the new one. Both must be changed. Most plans allow both to be done in the same session. Step 6. Confirm. Most plans send an email confirmation within 24 hours. Review it to ensure both the future contribution election and the current balance transfer are reflected correctly. The entire process takes between 15 and 30 minutes. It requires no financial advisor. It requires no knowledge of individual stocks. It requires only a login and the willingness to open the investment options menu for the first time. The cost of not doing this, for the average 401k participant over a 30-year career, is measured in the tens of thousands to hundreds of thousands of dollars, depending on balance size and contribution rate. My name is David. If this changed how you think about the fund you are currently invested in, hit the like button now. The next video covers the Roth IRA version of this decision. Which index fund to hold there? The one account feature that makes the tax efficiency even higher than the 401k, and the specific income thresholds that determine whether Roth or traditional is the right choice for your situation. One question for the comments. Do you know the expense ratio of the fund your 401k is currently invested in? Drop yes or no below. And if yes, drop the number. The answers tell me exactly what this community needs next.